Good afternoon, everyone. Anyone still alive? Yeah. So I'm the contrarian today. I'm here to talk about central bank digital currencies. I see we have a very anti-government audience. I'm going to help you guys today, okay? Because I actually spend most of my time talking to governments and central banks and all their concerns. So this should be an interesting discussion. So I'll start as this loads. My name is Darrel Hubbard. I'm a founding member of the Digital Currency Monetary Authority here in Washington, D.C. I started my journey in CBDC, or I shouldn't say CBDC, actually digital currencies and blockchain back in 2013. My team and I won several grants from the European Commission to work on various social and civic projects from the Horizon 2020 grant program. And from there, we got lots of worldwide recognition. We were written up in the European Commission, the United Nations, and the World Economic Forum. And we began collaboration with the Central Bank of China, as well as the Korean government on the Smart Cities Initiative and other digital currency projects, which led to eventually forming the DCMA here in DC. And the DCMA, our role is to, we are the innovation leader, and we consider ourselves the worldwide innovation leader in digital currency solutions for governments and central banks. I will go through some of our innovations here. We provide digital currency solutions, digital trade solutions, and digital payment solutions. CBDC is focused on national currencies. Actually, the DCMA, not only do we look at national currencies, but we also look at continental and global currencies as well. Let's see if I can get this flicker working. Do I hit the? Bring the mic up a little closer. Okay. Do I to change the slide? Oh. Okay. So BIS is the Bank of International Settlements. They do sort of research and innovations for banks, and most of the banking community is a part of BIS, and they've sort of put out guiding principles for CBDC and digital currency solutions. We sort of agree with much of the recommendations from BIS, and we sort of incorporate those guiding principles also in our recommendations to central banks. Today I'm going to talk a little bit about national currencies, continental currencies, and global currencies. Like we have the G7 and G20 coin, for example. We have an Africa coin for all of the continent of Africa. But I get into those details a little bit later. We have an issue on the slide. Can we try to get it? Okay. So first, I'd like to sort of address what's the difference between CBDC and what we all know as sort of the traditional crypto ledgers like Bitcoin, Ethereum, and Ripple, et cetera. And what some of the functional requirements. Can those ledgers work inside of banking as we know it today? And I would say the part of the most fundamental difference is, what Bitcoin operates in a anonymous, trustless environment. So it has, very complex consensus, proof of work to try to manage a trustless protocol. Whereas CBDC, the central banks are a trusted monetary system of an economy. So its consensus architecture should not necessarily be as sort of complex as a proof of work in a trustless environment. So the speed of being able to do transaction consensus in the CBD environment should look quite different from something like a Bitcoin or Ethereum type model. And the functional requirements are quite different. Most Bitcoin was designed for cash, the exchange of value between parties. Banking is far more complicated than simply a cash ledger. You have debits and credits and all types of ledger accounts. You can have negative balances in the bank. You have overdrafts. You can't have that in most of the public ledgers, right? So how do you solve the complexities of banking inside of these types of technology? The answer is you can't. You have to build a different type of ledger technology for CBDC. And probably one of the most controversial things I like to start with is so we talk to advanced economies like the G7 central banks as well as the emerging market economy central banks. And there's a common theme of questions we get to how do we solve this, how do we solve that. And the number one question across both of them is how do we make CBDC both private and completely traceable, right? That's the oxymoron. But it's very solvable, right? And the myth I want to dispel right now is everybody said, well, we don't want the government spying on us and doing surveillance on CBDC. The earlier gentleman said we don't want the government to be able to see our transactions in real time, right? But let me give you a wake-up call. The government can see all your transactions today, right? Every electronic payment is traceable, whether you're doing debit or credit cards, bank-to-bank transfer, or PayPal, or whatever your favorite cash app is, it's all traceable. So CBDC is not introducing new traceable capabilities to government. It just makes it faster, cheaper, and better. So yes, it can maybe trace faster, but that's not the point. Government should be able to trace transactions for AML, terrorist financing, and any other bad actor deal. So to think the government should not be able to have a security architecture that can make this monetary system more safe and secure is just a false idea and a false start. Even the GDPR, which is the General Protection Regulation by the EU, when we built our proposals to the EU on blockchain and digital currency, the number one thing was how can we implement GDPR in our systems. And GDPR allows for security analysts, people who have the specific role of security, to be able to audit and trace transactions. So now cash-to-cash transactions are not traceable. If you still want to do cash-to-cash, as people do today, that's in a CBDC won't affect that. But if you're doing digital currency is mostly an alternative to electronic currency or electronic payments, which is completely traceable. It's just not very efficient to trace. So our ledger technology can support private transactions, but no one can understand and see the digital signatures on the blockchain. However, those who have the role of security should definitely be able to monitor and trace those transactions for AML and other things of that nature. Right, so one of the big differences between CBDC and sort of the public ledger technology is KYC. In the banking industry, you can't open up a bank account without them knowing who you are, right? You gotta have identification, et cetera. So these types of technologies must be enabled on the blockchain as well, where you can actually have KYC along with all your crypto, or I should say CBDC transactions, right? So we recommend a registry because not only most of the AML that's happening in today's world is happening across banks and across country lines. So people, if you send $1 million on a bad trade deal, once the recipient receives that money, they're automatically moving it out of the country and moving it to another bank, to an offshore haven. So in order to be able to track these transactions globally, you really need more of a global register where every bank can submit the credentials of their client, and we give them a global ID. So everywhere they have a bank account, everywhere they have whether it's onshore or offshore, have the same identifier. So every person has a global identifier, whether it's a business or a person. And now we can monitor any AML activity that's happening across state or across country. Now, how can CBDC support all banking transactions? Well, again, Bitcoin and Ripple and all these other public ledger technologies are cash ledgers, right? How do you handle debt? They normally do smart contracts. On Ethereum, there's a bunch of smart contracts that every financial institution is writing to implement all types of DeFi and other applications. But the problem with it, that's not very scalable, right? And everyone is implementing these solutions in their own way. So you don't get a consistency in approach and compliance, legality, and sanctions if everybody's implementing their own algorithms for how to do DeFi. What you really need is more of what I call a multi-ledger DLT, where not only supporting cash, but can support every type of ledger transaction. So cash is where we started, but loans, disbursements like with coronavirus, the government wanted to be able to send out money to all the citizens for some type of financial relief. Investment ledgers, we've implemented about 14, a dozen different types of ledgers, all in the ledger technology. So these are not smart contracts that's written on top of the blockchain. This is part of the basic out-of-the-box ledger capability. So unless CBDC can support every type of banking transaction, what's going to happen? You're going to have the fiat world and CBDC only for money movement. In order to have a real true digital currency or a digital bank, you have to be able to support all the functionality of the bank on top of the, in my view, on top of the ledger, and not having each bank or financial application writing their own smart contract with inconsistencies and compliance and security to implement them. Right. Now, what we find is in the advanced economies, most of the G7, G20 countries, they are looking at CBDC and digital currency more for B2B transaction, commercial and capital markets, mostly around instant settlements, right? How do we improve the velocity of money so we can settle transactions faster and get more revenue? And I think we had the economists earlier talking about the velocity of money. This is really the big idea in capital markets. And of course, digital currency can solve that problem, or at least speed up that velocity issue around settlements. In emerging markets, they are more focused on retail CBDC. How do we, the sustainability issue, financial inclusion issue, how do we offer CBDC to all the customers in an equitable fashion where everyone have access to this future economy, right? How do we minimize the constant pull, this wealth gap that's people talked about earlier that's going to happen, but can we bring, the unbanked and the unconnected into this new world of CBDC, right? So there's a couple of R&D projects that we're undertaking right now for those that's not connected. One is sort of like prepaid Visa cards. You can have prepaid CBDC cards, your wallet and everything's on the card, and you can go and spend that CBDC with the merchants, even if you don't even have a phone device. But there's many phones in these emerging markets. They're not smartphones, and we luckily, literally, I have 3 smartphones. One, far too many. But most of the emerging market countries, many of them, they have feature phones, right? They're not smartphones. They're like the old Nokias, and they have Bluetooth, some of them, but they don't have Wi-Fi connectivity. How can they participate in this CBDC economy? So we're currently building a prototype right now where you can do point-to-point Bluetooth money transfers without any type of Wi-Fi. Well, how would that work? Because they're not connected to the general ledger. Right, so the transactions are happening totally through Bluetooth offline, and at some point there is some network connectivity, and we sync up to the main node network. But these are the type of ideas you see the differences between emerging market countries and the advanced economies. Now, again, one of the bigger issues is also interoperability. Right now we have SWIFT that sort of handles wire transfers between countries. We have a whole fragmented, distributed network of different payment systems. They all use the SWIFT messaging protocol. Well, how is this going to work in the CBDC world where you have different nodes, right? Every bank has to host hundreds of nodes for every other CBDC. It's not really practical of a solution, right? So we've created what we call the multi-currency wallet. And our big innovation around this is called CBDA. We're going to introduce that term right here today, cashback digital assets. What's a cashback digital asset? It's basically a stable coin that's governed by the banks. So Tether is a stable coin governed by a centralized private enterprise, but I can assure you most banks are not going to adopt Tether, right? The banks want to control the issuance and the governance of money. So we introducing cashback digital assets, which is the same concept, except it's governed by the bank, meaning only the banks can issue it. It's a decentralized model where any bank that's part of the central banking network can mint that coin based on their customer deposits. That way we can have one wallet. So this is a proposal we have in front of the African Union right now. The African Union has instituted what we call the African Union Free Trade Zone of 54 countries in Africa, right? And they introduce and trade amongst each other. And so we are going to the different central banks. They're suggesting our technology here that will help them figure out how to move money between these countries without having to do FX rates. So we have a coin literally for every single country, but for this slide, say if you just think about every country of Africa, they have that CBDA, which basically mirrors each of their CBDCs, but by having our CBDA, they all can have one wallet from the DCMA for every single currency, and then that multi-currency wallet will interface with the CBDC. So we basically become the middleware between all the currencies. Therefore, every bank doesn't have to try to host all these different nodes, right, and manage all that connectivity. So yeah, that's a pretty big innovation, and it's done by, again, through decentralized governance. So any bank will be able to issue the CBDA based on customer deposits, and mint that coin accordingly. Now, compliance, legal, and sanctions. Now, in Bitcoin, do you have compliance, legal, and sanctions review on transactions? No, right? Of course, in the CBDC world, you have to be able to follow the regulatory compliance, FinCEN compliance, and things of that nature. So right now, every financial services company are responsible for their own compliance, legality, and sanctions implementation. I think that's not efficient. What if we can centralize this at the CBDC level, and every transaction that happens, the network ensures that it meets compliance, regulatory, and sanctions rules and enforcement, right? So we're not relying on each institution to implement these protocols distinctly. We can build this into the currency protocol. So this is one of the things that we've done, and we are suggesting to each central bank that they build sanctions and compliance and legality into the protocol and not rely on each financial services company for that. Let's talk about some of the specific innovations that we are doing. Now, the four things that can really impact banking of the future is artificial intelligence, cryptocurrency, tokenized digital assets, and sustainability. This was an article that was published by the Future of Finance. And we've seen all four of these areas. So I'd like to talk about, especially number one and number three, how does artificial intelligence work with digital currencies to create smart money? This is an area that I've been very keenly involved in for a few years. Many of you are probably familiar with the Blockchain Week in Hong Kong. Back in just 2 years ago, we submitted, before we formed the DCMA, an innovation to Blockchain Week of an income-producing stablecoin. It's basically a stablecoin that generates yield intrinsically using AI without having to subscribe to some third-party offering. And we won the Innovation of the Year for that, and we use that as the basis for many of our currency innovations today. I'll explain some of them to you now. So AI, think about AI and money. So there's all these DeFi systems out there that's generating yield. So your money should be making money for you while you sleep. My vision is the future will have smart wallets that can know your customer behavior, know your spending, and know your availability of cash, and it should be automatically subscribing you to yield-producing DeFi situations, while you automatically should have your KYC, your profile with your accredited investor, non-accredited, and your smart wallet should constantly be making money for you. And this is also going to happen on the banking side. Central banks, they are affected by FX rates, especially global banks, right? Many of them are offering interest rates based on how well they fare against the US dollar. And they need to be able to have risk mitigation technology that can generate yield through AI and their FX and their cash reserves. So we built one for the last 4 years, an AI system that basically handles treasury management and based on market fluctuations, know how to generate yield to protect against market fluctuation. And we are bringing that technology into digital currency. Let's get this slide and come back to it. But one key innovation is called the neutral monetary unit. Now, across the world, there's several free trade zones. Like we had the North American Free Trade Agreement. We had the Euro, European Union Free Trade Agreement. Asia, Southeast Asia has its own free trade agreement, in the African Union. So we've created a currency for each of these free trade zones. The reason is whenever you trade across country, there's FX rates, and there's always money loss in that conversion, right? So if you have a currency for each free trade zone, now you can store a balance for that currency, and you can minimize those FX rates and actually generate interest on that balance. Right now, FX is only a transaction. What if we can turn FX into a currency that you actually can hold a balance? So if you would actually receive money in the North American coin, for example, you can hold that balance and pay someone else in the future. The real benefit of that with our neutralized monetary unit is it eliminates FX depreciation. So the US to Mexico, I don't know if you many know, was started around 1994. $1 gave you how many pesos? Anybody can guess? How much was $1 to the US peso in 1994? 10? 5? No, 3.3. $1 gave you 3.3 pesos. Today, $1 gives you 21 pesos. Mexico don't like that. They should get out of the drug business, they do better. But my point is, many currencies around the world is being affected by the advanced economy to the emerging market slide. Even the U.S. in the last year has taken some serious deals with the coronavirus and our treasury printing a vast amount of money. But the point is, our innovation here at the NMU is if you buy a currency, whatever the FX rates that you purchase, you will maintain that FX rates for the duration of that transaction. So you are not exposed to any volatility up or down in the currency, right? So this is a pretty big innovation, and it's not a security, right? It's actually a product that we can actually sell to small businesses or even to retail consumers. Now, another innovation is called the CDC, Composite Digital Currency. Now, this is in the U.S. considered a security because it's like a composite index, like a basket of currencies. So we can implement a continental currency or a global trade currency, both as a CDC, which we could take the G20, for example, the G7 countries, and put them in one currency. And some people may prefer to hold their money there versus one native currency, right? Or the NMU, they can get total FX exposure, minimize any FX risk by holding the NMU. I think I already gave you some information about myself. So that pretty much concludes my presentation. Any questions on any of the ideas I presented here today?
A lot of questions. But
Give me one.
So step up to the mic. Okay.
And just one question.
With this CDMA type multi-currency wallets, with debits and credits, so can you start to incorporate like natural assets like emissions trading and different types of financial instruments like swaps and other types of?
Yeah, so the multi-currency wallet we support various types of assets today, but no private assets. So this is only for the banking industry. So the DCMA, we had no interest in private sector tethers and things of that nature. So we only mint coins that's governed by banks. So any assets that's controlled and governed by the banking industry, we're allowed to adopt it.
How you doing, sir? My name's Randy Schwartz. I'm director of the New York Bitcoin Association. How you doing?
Good.
Question is, you mentioned all these blockchains that don't scale or whatever. With Bitcoin, with the original protocol, with op returns, we can do all this stuff, this banking stuff that you're talking about. We can trace money. There's, all this stuff that you're talking about, and you're talking about inventing a new currency. Backed by, but we already have that with Bitcoin. So with these closed blockchains that you're proposing, that the banks run and these nodes run, why wouldn't you just use Bitcoin that scales, Bitcoin SV?
Okay. Well, it's two reasons. One, the banking industry, even though stable coins and other technologies, the Feds have already said that banks can adopt those, and some banks will bring those technologies in, maybe through intermediaries. But the banking industry wants to be able to sort of manage and govern money. That's what the role of the central bank is, right? To manage and govern the monetary system and control the monetary system. So now, even though Bitcoin you can scale through other technologies, other innovations, what I was suggesting, the ledger itself. People are writing smart contracts to take, I guess, the deficiencies that's in Bitcoin. Bitcoin is really only a cash ledger, but if you can write other software code on top of it, you can implement anything.
That's not true. You can put it right in the blockchain. We put NFTs and all sorts of stuff right in the blockchain.
Yeah.
Pictures, video, everything. You can do everything.
Yeah. Well, of course, again, you can build a blockchain to solve any problem, but you're writing unique code for each of these use cases. The ability to have a multi-ledger is out of the box. The banking industry has a ledger that supports all types of transactions. But of course, you can write smart contract code on Ethereum, possibly to solve any of these problems. But the problem is, each institution is writing it their own way. this is only our proposal and suggestions to have a multi-ledger technology that can solve debts, credits, all the different things I listed in the presentation. Not that it can't be solved through other programs, but as you can see on Ethereum, every time someone writes a different smart contract, they typically have security vulnerabilities and other issues and inconsistencies in thought. Where if you have one ledger, you can monitor and trace that entire ledger versus having everyone writing their own smart contracts to implement that functionality.
So how do we audit the banks?
Audit?
Yeah, how will we audit, like, to make sure the assets are really there?
Oh yeah, so the blockchain is still could be transparent. It's just
But
like,
if it's controlled by centralized.
well, it's still a
whereas-
transparent ledger.
So with proof of work, with the real proof of work blockchain, it can't be stopped. Even if some miners drop off, more miners can jump on. But all these central bank currencies are all proof of stake. Whereas if they all agree to shut down or whatever, they can shut down. And as far as me, I don't want to see the world shut down. So
Man, I mean, I hear your point of view there, but
I appreciate it.
Yeah.
Thank you.
But
That's all.
thank you.
Sorry, guys, we gotta move on. We're
Yeah.
just getting into our lunchtime, so we gotta.
Yeah. I'm available if anybody have any other questions afterwards. Thank you so much.